Good day, students. I will be doing question 3, which is out of 30 marks. And this question is on the topic of cash flow. And the name of the company is SCOOBIE LTD. And it says statement of financial position as at 30 September in the year 2010. So we are given the statement of financial position up to the end of December in the year 2010. And I want to bring your attention to few or three things in this balance sheet or statement of financial position, more especially under non-current assets. Under non-current assets, we are given property, and they don't specify either as a cost price or carrying value. But very importantly, if you see under equipment, we have equipment where they don't specify, they just say equipment, which is 156,000 and 140,000 for the year 2009. And we have equipment at cost, and after we have equipment or accumulated depreciation for equipment for both years 2009 and 2010. And that means the cost price minus accumulated depreciation will give us the equipment of 156,000 for the year 2010, and the equipment carrying value for the year 2009 is 140,000 rands. If you see that, it's very important. So now that means the first equipment just below after the property is equipment at carrying amount. So now that means the 156,000 and 140,000 is the carrying amount of the equipment, which is the cost price minus accumulated depreciation. As you can see that in the box, they deducted the two. So now we are given the cost price of the equipment together with the carrying value of the equipment. Then after, they also gave us motor vehicles. Once again, another thing to note with the motor vehicles. We are given motor vehicles, and that is a total of 150,000 for the year 2010, and there is no vehicle in the year 2009. And if you see that 150,000, it was the vehicle cost price of 180,000 and accumulated depreciation for vehicles of 30,000 for the year 2010. And if you say 180,000 minus 30,000, that will give you the vehicles at carrying amount of 150,000. That means that 150,000 for vehicles is at carrying amount, or the carrying amount of the vehicle. If you want, you can highlight that and say vehicles at carrying amount where there is 150,000, as I have noted it. Then after, we have investments, and they are recorded correctly. And I also want to bring your attention to the current assets. Under our current assets, we have current tax refundable income tax. That's what I want to highlight before we start. Our current tax refundable income tax in the year 2009, it is 3,220 rands. This is income tax refundable. That means this income tax is an asset, meaning now SARS owes us the tax of 3,220 rand. So now, when we are calculating income tax, we have to consider that the opening balance of the current tax refundable will be on the debit side because it is an asset, hence it is recorded under current assets. Then after, I want to bring your attention once again under current liabilities. If you see under current liabilities, we have what is called current tax payable, the second one after account payables. That current tax payable, if you see there, it is 6,444 rands. And that current tax payable is under current liabilities. That means by the end of the current year, we were owing SARS a tax amount of 6,444. However, at the end of the year 2009, at the end of the year 2009, we were owing SARS an amount. SARS was owing us an amount of 3,220, the one that is current tax appearing under current assets. However, at the end of the current year, SARS was owing SARS 6,444. So now by the end of the year 2010, it was a liability, but by the end of the year 2009, tax was an asset. Please take note of that, because when we do calculations of tax, we have to take into account the fact that opening balance of tax was an asset and closing balance of tax was a liability. So those are two very important things that I want to bring your attention to. Now, before I read the requirements, or before I go through what is required, or before I do the additional information, in fact, I prefer to go to the requirements. Before we go to the additional information, let us go and see what are we required then to do. Our requirements are 3.1 and 3.2, where we are required to do the reconciliation note. Then after, we are also required to do the statement of cash flow for the year end 30 September 2010. So now these are the two requirements that we'll be answering. We are doing the cash flow, and before we do the cash flow, we first have to do the reconciliation note to reconcile the net profit before tax with the cash generated from operations. So now let us start with the additional information, and in doing that, we know that we will be doing the note, then after we do the profit, the reconciliation, after we do the cash flow. Number 1 says on the 31st of May 2010, 250,000 preference shares were issued at 50 cents per share, and the share issue expense amounted to 1,150, and we know that this will be a cash flow that will go to cash flow from financing activities. So that will affect our cash flow from financing activities. Then number 2 says that during the year, the following transaction took place with regard to non-current assets, and these non-current assets are included already in the profit before tax. So now that means all these transactions were already taken into account in the profit before tax. They tell us that there was an investment of 62,000 rands cost price, which was sold at a profit of 6,225. Then after, there was a property that was sold for 260,000, and they say no further sale or purchase of property were made during the year. Then after, it says no equipment was sold during the year. And number 3 says there were no components of other comprehensive. And number 4 tells us that an additional short-term loan of 50,000 was raised during the year. So now the entries that we see under additional information number 2, those entries, they will affect our cash flow from investing activities, because investing activities is focusing on the assets. More especially, non-current assets will be the one that will be affecting the cash flow from investing activities, because we invest in assets. We don't invest in liabilities. Then after, number 3 will also be a cash flow element, or say there were no other components that will be income statement, but there's no need for us to record that because there were no other comprehensive. However, number 4 will be cash flow from financing activities, because we finance, in this case, our assets, or we finance our investments through the loan, where there was a loan that was raised. So now, after we have read all that, we can now go straight and we start doing our reconciliation of profit before tax with cash generated from operation. And we know that to do the reconciliation, we start, if you see the below adjustment number 4 or below additional information number 4, we are given the income statement. And our income statement is made of revenue from sales up to the total comprehensive income. And there in the middle, we have our profit before tax. And our profit before tax amounted to 288,491. That is the profit before tax in the income statement that we see below there. So now that will be useful when we are doing the reconciliation note. And also take note that after the income statement, we have the statement of changes in equity. And that statement of change in equity will also be taken into account when we do the cash flow statement. Now let us do the reconciliation note, where we start with the profit before taxation. So now we start with the profit before tax when we do the reconciliation note. And our profit before tax, as I have shown you, that profit before tax is 288,491. Then we say profit before tax expense. And we write that profit before tax as 288,491 is our profit before tax. And after that, we have the next line item, and the next line item says non-cash flow items. Non-cash flow items. And under non-cash flow items, we have items that are not cash flow items. Under non-cash flow items, the first one is normally depreciation, because there is no cash flow that comes into the business because of depreciation. So now we have to look at the depreciation that we have for all the assets that are recorded in the statement of financial position. And now, since we have read the additional information, in the additional information, there was nothing stated about the depreciation and how depreciation must be calculated. So now that means the only way we can get to know the depreciation is to go to the statement of financial position. And under the statement of financial position, we have two assets that are depreciating. And those two assets that can depreciate is equipment and vehicles. So now those are the two depreciation or assets that do depreciate. Property does not depreciate in this instant. So now that means for us to calculate our depreciation, we have to look at the accumulated depreciation of equipment for the year 2009 and the accumulated depreciation for equipment for the year 2010. And we see that the accumulated depreciation for the year 2009 for equipment was 60,000, and the accumulated depreciation for equipment for the year 2010 was 84,000. And we know that the reason why there's a difference between the two is because a depreciation for the current year, meaning for the year 2010, was added to 60,000, and that became 84,000. So now that means our depreciation will be an amount of 24,000, being the difference between 60,000 and 84,000. Then you say 84,000 rands minus 60,000 rands, and this will give us the total depreciation of 24,000 rands for equipment, depreciation for the current year. Then after, we look for the depreciation on vehicles, and we can see that depreciation for vehicles, there was no accumulated depreciation for the year 2009. Obviously, that means there was no vehicle in the year 2009. Therefore, now the accumulated depreciation that we have in the year 2010, which is 30,000, becomes the depreciation for the current year on vehicles. Therefore, now that will mean it's 30,000 rands. Depreciation total will be 24,000 rands and 30,000 rands. And if we add the two, that will give us the total of 24,000 rands plus 30,000 rands, and that will give us 54,000 rands at the total depreciation for the equipment and for vehicles. So now our total depreciation that will appear in the reconciliation note will be 24,000 rands depreciation for equipment plus 30,000 rands depreciation for vehicles. Therefore, now the total depreciation of 54,000, which is a non-cash item that must be cancelled or reversed or reconciled, will be a total of 54,000 rands. And please remember that the reason why depreciation must be recorded as positive is because in the income statement, depreciation was recorded as negative, reducing the profit before tax. However, now we are removing this depreciation because it's a non-cash item, it's not cash, and when we do cash flow, we only want to take into account cash flow items. So now we are removing all the non-cash items or items that they don't have cash flow in the income statement. So now that will be positive because in the income statement, depreciation is an expense. It was recorded as negative. Therefore, now we go and look for another non-cash flow item. And in our income statement, we have to look at the non-cash flow items. And if you see in the income statement there, below adjustment number 4, we have the income statement or statement of comprehensive income. And in the statement of comprehensive income, we have other incomes. The third line item, if you see then the income statement, other incomes. Under other incomes, we have profit on sale of investment. And after, we have profit on sale of property, which is 35,000 and 6,225. Remember, a profit that you make on the sale of an asset does not necessarily mean that the business has received any money. It's just that is the profit that was recorded in the income statement. So now, profit again being a non-cash item, then we remove that from our reconciliation note. Therefore, now we know that profit would have been recorded obviously in the income statement as a plus. Therefore, now when we remove that profit, it has to be removed as a negative, because profit would have been increasing our profit before tax. So now both profits are non-cash items and they must be removed from the income statement or removed in the reconciliation note. So now we have these two profits that must be removed, which are non-cash items. Therefore, now we have profit on sale of property. Profit on sale of property, and that profit on sale of property, as we have seen, that it amounted to 35,000 rands. So now that 35,000 rands increased our incomes. Therefore, now we are removing that profit, and another profit will be a profit on sale of investment. Profit on sale of investment, and the profit on the sale of investment amounted to 6,225, and that must also be negative, because in the income statement profit was recorded as an increase in profit, or increased our profit before tax, which is 6,225. So now we are reversing that profit, then it must be recorded as negative. And now these were the only three items that were non-cash items. Remember, if there was also a loss on the disposal of an asset, a loss on the disposal of an asset was also going to be reversed as the non-cash items. But now we don't have a loss on the sale of any asset. And remember, a loss was going to be reversed and recorded as positive, because a loss would have been recorded as negative in the income statement. So now when we do a reversal of the loss, a loss will be recorded as positive. And together it may be there's a write down of inventory or inventory loss. Therefore, now inventory loss was also going to be taken into account in the reconciliation, and that was going to be recorded also as positive, reversing that in the reconciliation note. So now these are the non-cash items that we have to take them into account. Then the next line item in the reconciliation note will be items shown in the main statement. That will be a heading. Items shown in the main statement. Items shown in main statement. That means items that are separately disclosed in the main statement. So now under items that are shown in the main statement, we'll be recording items that are recorded independently in the main statement, which is the income statement. And one of them is the finance cost or interest expense. Let us start with that finance cost. You just have to memorize most of the items that come here. And another one will be normally interest income, if there is interest income. That will be interest income. Now let us check if do we have finance cost or any interest income in this exercise. So now in the income statement, all this they're supposed to be reflecting there in the income statement as finance cost or interest income. Now in the income statement, the second line item, it is revenue, which is interest income. And remember, this interest income is an amount of 1,600 rand. And we are removing this because interest income is not because of the main operation of the business. That is why the interest income of 1.6 is not included under our sales revenue, because that interest income is not because of the operation of the business. It's not because of the trading activity of the business. That interest income is because maybe we invested money somewhere else and we received this interest. However, this interest is not because it's the main revenue for the operation or for the activities of the business. So now it is not because of the operation. And remember, we are doing the reconciliation of profit before tax with cash generated from operation. So now in this case, we are removing all the items that are not because of the operation of the business, but it's just incomes that were received, not related to the operation, and also expenses that were paid, but not related to the operation of the business, just like finance cost. Finance cost is the interest that we just incur because we borrow money from the business, and it's not because of the main operation of the business. The business is not there to pay interest in order for it to operate. So now that is why we have to take into account that interest income of 1.6. And also there is finance cost in the income statement. There is finance cost in the income statement. And that finance cost is 68,134. 68,134. And that interest income, second line item, is 1,600. So now these two must be removed because they are not part and parcel of the cash that was generated from operation. Finance cost is 68,134. Remember, finance cost was recorded as negative and it reduced the profit before tax. However, now since we are doing a reversal, therefore now the finance cost will have to be a positive, reversing the negative that was recorded in the income statement. And the interest income is 1,600. And remember, this interest income was recorded as increase in our revenue, meaning this income increased our profit before tax. So now we need to make a reversal of this, and to reverse this, we have to cancel it by recording it as a negative amount to make sure that we are canceling that 1.6, which was income not related to the operation of the business, just income received from maybe a positive bank balance or maybe from an investment. So now these are the only two items that are separately disclosed in the face of the income statement, and we have recorded these two and we have reversed them in our reconciliation note. So now after we have done this, we can then calculate the total of the two items, and these two items will be a total of 68,134 minus 1,600, and the total of that will be 66,534. Then we also have to add the total of the non-cash flow items, and the non-cash flow items starting from depreciation up to the profit on sale of investment. We have to add all those three so that they give us the total of non-cash flow items. Therefore now depreciation of 54,000, which was positive, minus 35,000 profit on sale of property, minus 6,225 profit on sale of investment. And this will give us the total of non-cash items as 12,775. That will be the non-cash flow items, 12,775. Then now we go to the last interesting part of the reconciliation note. The last interesting part is the working capital changes. The last interesting part is the working capital changes, where we focus on the working capital changes. And our working capital changes is three things: inventory, trade receivables, and trade payables. It's only the three that get to be recorded under working capital changes. So now first we have to go to the statement of financial position, and we look for the inventory. And in the statement of financial position, we do have inventory under current assets. And our inventory in the statement of financial position under current assets, in the year 2009, inventory was 65,600. And inventory in the year 2010, it was 73,000 rands. Take note of that. Our years are there on top, 2010 and 2009. They are there on top. So now we see that inventory increased by the difference. Inventory increased in this case. Inventory increased from 65,600 to 73,000 rands. And we need to determine the amount by which our inventory increased by. Therefore now is 73,000 rands minus 65,600, and our inventory is 7,400 rands. That is the amount by which our inventory increased by. Now, if our inventory increased by 7,400, we need to ask ourselves, when does the inventory increase? Obviously, inventory will increase if we buy more inventory. And please take note of this as we go to the reconciliation. Let us write first this, and you say increase in inventory. increase inventory. And our inventory increased by 7,400. Let us write 7,400 before we explain either is it a negative or a plus. And I want to bring this to your attention, and I will write brackets. Please don't write this in the exam as your workings. Under inventory, we always assume cash basis. Assume cash basis. And please don't write this in the exam. I'm just using this for the sake of you to understand this part. When I say assume cash basis, that means assume that if inventory increase, it means we bought inventory for cash. So that is the assumption. And now if inventory is increasing and we bought it for cash, therefore now this will be outflow of cash. Therefore now we indicate that as negative. Take note of that. We indicate that as negative. So now it will be negative because we bought inventory for cash. Hence I'm saying under inventory, please always assume cash basis. That means whenever inventory will decrease, that will mean we sold some inventory to a customer. And if you sell inventory to a customer, it will decrease. Therefore now that will mean cash came into the business. Hence I'm saying when you come to inventory, always assume cash basis. Inventory increasing, we bought more inventory for cash. Therefore now that will be negative. Inventory if it's decreasing, therefore now we sold inventory for cash. That will mean money is coming into the business. That is why I'm saying always under inventory, assume cash basis. In this case, inventory increased. That means we bought more inventory from the supplier and we assume that it was cash. Therefore now that 7.4 will be a negative. The next one will be our account receivables. Our account receivables still under current assets. Our account receivables in the year 2009, account receivables in the year 2009, they were previously 76,580. And in the year 2010, there were 70,825 rands. Now that means our account receivables, they decreased. Let us determine the amount by which our account receivables decreased. It is 76,580 minus 70,825. That means our account receivables decreased by 5,755 rands. And obviously, whenever account receivables decrease, it means our customers have paid us money back. That means our account receivables or our debtors, they paid us money back. Therefore now this will mean we received money. And if we receive money, therefore now it will be recorded as positive, cash coming into the business. Therefore now we say decrease account receivable. A decrease in account receivables. And this will be recorded as positive. 5,755 rands. I think it was like that. Yes, 5,755 rands. That will be positive, indicating that we received cash from the customer. And remember, cash from the customer is because of operation. Don't forget, cash from the customer is because of operation. So now we take this into account as cash coming into the business because of operation. Then another one will be account payables, which is the third working capital changes. Account payables are found under current liabilities. There we do have account payables under current liabilities. And account payables in the previous year amounted to 71,250. And in the current year, they amounted to 48,175. And we see that account payables are decreasing. And the minute account payables are decreasing, it means we paid money out. And if we paid money out, therefore now that means it's cash outflow, cash going out of the business. So now let us check how much cash went out of the business to pay our suppliers, which is 71,250 minus 48,175. That means our account payables, they decreased by 23,075 rand. 23,075 rand. That means money went out of the business, 23,075, and that will be recorded as decrease in account payables, and it will be negative, indicating the outflow of cash. Then we say decrease account payables. A decrease in account payables. And our account payables decreased by 23,075 rands, and that will be negative, indicating the outflow of cash. And after, we can immediately calculate the total of the working capital changes, which is negative 7,500, sorry, 7,400 for inventory, plus 5,755 minus 23,075, and this will give us 24,720, which is negative. Take note of that. 24,720, which is the net of our working capital changes. Therefore, now we have to calculate the total, and the total is cash generated from operation. The total is cash generated from operation. Cash generated from operation. Cash generated from operation. So now in this case, inventory, money went out, it was not generated. For account receivables, we generated some money. For account payables, money went out. Therefore, now we recorded all those. Therefore, now our cash generated from operations will be a total of the profit. Let us calculate everything. Our profit before tax is 288,491 plus 12,775, which is our non-cash flow items. Then after, we plus 66,534, 66,534, which is items shown in main statement. Items shown in the main statement. Then after, we subtract 24,000 of the working capital changes, 24,720, and that gives us 243,080 as our cash generated from operation. Therefore, now this will be our cash generated from operation, and that is 343,080 rands. That will be what will be recorded as our cash generated from operation. So now this is the end of the reconciliation note. The end of the reconciliation note, and you'll have already got your 10 giveaway marks in this cash generated from operation total. Now we come to our statement of cash flow for the year ended 30th of September in the year 2010. And our cash flow starts with the cash flow from operating activities. It starts with the cash flow from operating activities. And we start with that with cash received from customers. The first line item is cash received from customers. Cash received from customers. And when it comes to cash flow, it becomes very important to know how to calculate almost each of the line items. Under cash received from customers, we need to do our calculations. And for us to do our calculations, we have to go back to our balance sheet or the statement of financial position. And under statement of financial position, we have the account receivables. So now to calculate the amount that was received from customers, we need to go to account receivables, and we say opening balance. Our account receivables opening balance plus sales minus closing balance. Minus closing balance. This will give us cash that was received from customers. The opening balance of account receivables will be the closing balance of the year 2009. And the closing balance of the year 2009 was 76,580 under account receivables. That become opening balance in the year 2010, because we want to know how much was received from customers in the year 2010. Therefore, now we say opening balance of 76,580, and we add our sales. Our sales will be found in the income statement, and our sales are in the income statement. They amount to 1,750,000 rands. We add our sales 1,750,000 rands. Then after we subtract our closing account receivables. Our closing account receivables will be account receivables in the year 2010. And our account receivables for the year 2010, they are 70,810.25. Therefore, now the total of the three will give us cash received from customers. This will be cash received from customers. Why will this be cash received from customers? Is because if you see in the account receivables, we have an opening balance. Opening balance in the account receivables, as we have seen that it was 76,580 in the year 2009. That became opening balance in 2010. Take note of that. This was a closing balance. Let me highlight this with the different color. This was closing balance. Closing balance in the year 2009. And the closing balance becomes opening balance in the year 2010. So now that is why we take the 76,580 as opening balance, because it's opening balance for 2010. Then after we add our sales, I want to emphasize this, we add our sales. Remember, these are the sales that were made during the year. And we also assume that all the sales were made on credit. Take note of that. We assume that all the sales were made on credit. That is our assumption. So now we assume that all these sales were made on credit. Therefore, now we say opening balance, which is account receivables plus all the sales. Then after we subtract the closing inventory, the closing account receivables. And the closing account receivables is the account receivables for the year 2010. That was the closing balance of the account receivables, 70,825 at the end of the year 2010. So now we say opening plus sales minus closing. That will give us the cash received from customers. Cash received from customers. Therefore, now we can calculate that and say opening balance 76,580 plus 1,750,000 minus 70,810.25. And this will give us 1,755,755. 1,755,710.55 rands. So now this will be cash generated from or cash received from customers. That will be recorded under as the first line item under cash flow from operating activities. 1,755,755. That is cash received from customers. The next one will be, or let me just repeat this from a ledger account perspective. Let us open a ledger account for debtors, please, because sometimes it can be required to do a ledger account for debtors. So now we open a ledger account for debtors. And our ledger account for debtors will have an opening balance and the closing balance. It will have an opening balance and closing balance. So now that means our opening balance for debtors will be on the debit side. And the opening balance for debtors will be how much? 76,580, which is account receivables in the year 2009 is the opening balance of 2010. Then our closing balance will be balance carried down on the credit side. Balance carried down will be the closing balance, and that closing balance will be 70,825. Remember, these are the amounts of the account receivables, opening balance, which is closing 2009, and closing balance, which is closing 2010. Opening balance on the debit side, closing balance on the credit side. Then after we record our sales on the debit side. Record sales on the debit side, and our sales are from the income statement as I did show you. Our sales is 1,750,000 on the debit side of the ledger account. 1,750,000 rands. Then after we can balance our ledger account. That means we have to take the total of the bigger side. And the bigger side is the debit side. And our debit side will be 76,580 plus 1,750,000 rands. That will be 1,826,580. 1,826,580. That is the total of the bigger side, which is the debit side. Then after we minus the credit side or the balance, which is 70,825. Then that will give us the total on the credit side as 1,755,755. So now the contra entry will be bank, because this is money that we received from customers. Therefore now this is how you can do it from a ledger account. Debit side 76,580. Then after opening balance you record sales 1,750,000, and on the credit side will be the closing balance of 70,825, and the difference will give you the same amount of 1755,755. And it's very important to know how to record this or to do these calculations, both from a ledger account perspective and general calculations, because you might be required sometimes to do a ledger account. Please take note of that. The next part is cash paid to suppliers in the statement of cash flow. Then we have cash paid to suppliers and employees. Cash paid to suppliers plus employees. And this one you don't calculate it, it will be just the difference between the cash generated from operation and the cash received from customers. Then the third line item will be cash generated from operation. This one comes from the reconciliation note. Cash generated from operations. Cash generated from operation. Cash generated from operations. And our cash generated from operation was 343,084. It comes from the reconciliation note. Take note of that. Copy that as it is. 343,080. That is our cash generated from operation. 343,080. Therefore now if you say cash received from customers 1,755,755 minus 343,080, that will give you cash paid to suppliers and employees, minus 343,080. 343,080. This will give us 1,412,675. That will be our cash paid to suppliers and employees, 1,412,675. Therefore now that will be our cash paid to suppliers and employees. If you are a second year student, this will be a note that you will do in your third year. Cash paid to suppliers and employees will be a third year note for those who are doing second year. Therefore now we go to the next part, and the next part will be the recording of the interest paid, interest received, dividends paid, dividends received, and the normal tax. And you need to memorize, guys, this format. The skeleton is something that you need to memorize in your heart. So now we have interest, we have interest paid, we have interest received, the second one. Then after we have dividends paid and dividends received. Dividends paid and dividends received. Then after we have normal taxation paid, normal tax paid. Normal tax paid. Now let us check which ones are there and which ones are not there. We start with the interest and check if did we have any interest. Remember, interest is finance cost. Interest is finance cost, and finance cost will be found in the income statement. Finance cost will be found in the income statement. So now we first have also to check in the statement of financial position if there was no maybe any interest that was accrued, but that would have been taken into account under account receivables or payables. So now in this case we don't have any accruals in the balance sheet. Then we can go to the income statement straight. In the income statement we see that we do have finance cost, which is interest expense, and that interest expense is 68,134. So now there was nothing to adjust with this in the balance sheet. There was no accrued interest, opening balance and closing balance. If there was accrued opening and closing balance, accrued interest, then that will have to be taken into account, but there was nothing in the balance sheet. Therefore now interest that was paid will be the one that you see in the income statement of 68,134. 68,134. Remember, interest that we pay is money going out. Therefore now that interest will be negative, interest paid. Let us then check if was there any interest that was received. Now once again in your balance sheet, if there was no accrued interest income, that means we can just go to the income statement. But if there was accrued opening balance and closing balance of the interest income, that will first have to be taken into consideration. So now there was interest income in the income statement, which was the second line item, 1,600. That was interest income, money coming into the business. Therefore now under interest received we have 1,600. That means this is cash that flew into the business. Therefore now if this is money came into the business, meaning now it will be recorded as positive because we are doing cash flow. Money go out negative, money comes in, it will be positive. So interest received 1.6 will be positive, as I said. The next one will be dividends paid, and this is also very important in terms of the calculations. Dividends paid. Now when it comes to dividends, you first have to go to the statement of financial position, and in the statement of financial position there is shareholders for dividends under current liabilities. Shareholders for dividends in the year 2009 it was 62,500. In the year 2009 shareholders for dividends was 62,500, and in the year 2010 shareholders for dividends was 75,000 rands. So now we do have dividends opening balance and have dividends closing balance. And if you see once again in your statement of changes in equity, the last statement, your statement of changes in equity, the last line item is dividends, and there are two dividends that were declared in the current year, and those dividends is preference dividends and ordinary dividends is 112,000 and 12,500. That means these are the dividends that were declared in the current accounting period. That must also be taken into account when we calculate the amount that was paid in terms of dividends in the current year. So now let us do our calculations as usual. We are doing our calculations for dividends, and now we do the same thing once again. We open the ledger account. We open the ledger account, and the name of the ledger account is shareholders for dividends. Shareholders for dividends. And we know that our shareholders for dividends is a liability account, and the opening balance for shareholders for dividends will be on the credit side, and that opening balance will be 62,500, and the closing balance will be on the debit side, which is the balance carry down will be on the debit side as 75,000 closing balance. Then now we have to record dividends that were declared in the current year, and dividends that were declared in the current year will be recorded on the credit side as dividends. And those dividends are the ones that we take from the statement of changes in equity. And in the statement of changes in equity, we have to add both dividends, the 112,500 of the ordinary plus the 12,500 of the preference. That will give us 125,000 of the dividends that were declared during the current year. Then we record that as 125,000 rands on the credit side of the ledger accounts of shareholders for dividends. Then after we draw two lines to balance this ledger account. We draw two lines to balance this ledger account. The credit side will be 125,000 plus 62,500. 125,000 plus 62,500. That will give us 187,000. So now that means our credit side is bigger. 187,500. 187,500. Then after we say minus the debit side. Debit side is 75,000. Then you say minus 75,000, and this will give us 112,500. And that 112,500 will be under the contra entry called bank, because this is the money that you would have paid to our shareholders in the form of dividends. So now 112,500 will be dividends that are paid, or that we paid at the end of the current year. Or else, if you wanted to do a shortcut, you could have just said opening balance, and opening balance is 62,500 plus dividends, and our dividends is 125,000, added both of them, minus closing balance. Very simple. Our closing balance is 75,000. So now I could have said opening plus dividends minus closing. Therefore now it will be the same amount, which is 125,000 plus 62,500 minus 75,000. Then that will give you the same 112,500 without doing a ledger account. But it's very important to understand both of them, how to do the ledger account and how to do just the general calculations. So dividends that we paid will be 112,500, and they will be recorded negative under cash flow from operating activities, 112,500. Now we go and we check if were there any dividends that were received. And in the income statement, that is where we see all the income that were received. And in the income statement, there was no dividends received. It's only interest income that was there. So now there was no dividends income or dividends received. Therefore now that means under dividends received, there is nothing to record in the cash flow. So now we can just erase that part. Then now the next part that you must record is the normal tax. The next part is the normal taxation paid. That means the amount of tax that was paid in the current year. Once again, we need to do the calculations with the tax again. When it comes to cash flow, you have to calculate almost everything. Please accept that and love financial accounting, even if there's many calculations. Now we go to our taxation expense. Remember, I said with regard to taxation expense, you need to take note that under the current assets in the statement of financial position, under the current assets, there was current tax refundable income tax, and that was 3,220. And this is an asset. That means SARS was owing us money by the end of the year 2009. That means now when we open the ledger account for normal tax, let us open the ledger account for normal tax. When you open the ledger account for normal tax, that will be normal tax, income tax, normal tax, semicolon, income tax, because there are many taxes. There's also dividends tax. Therefore, now our normal tax, current tax, our normal tax, income tax, opening balance is the closing balance of the year 2009. And the closing balance of the year 2009 was 3,220 an asset. Therefore, now the opening balance will still remain an asset on the debit side. Take note of that. The opening balance is still an asset, 3,220 on the debit side. It was closing an asset, then it becomes opening an asset. Take note once again that the closing balance now, the closing balance is under current liabilities. The closing balance for current tax, or for normal current tax payable, normal tax. The closing balance for the current tax is a liability, and this closing balance is 6,444. So now we have to record the closing balance. And remember, if the closing balance is a liability, the carrying balance of a liability is on the debit side. or the balance carried down of a liability is on the debit side. So now if the balance carried down of a liability is on the debit side, therefore now it means the closing balance for this current tax will be on the debit side. So now the opening balance is on the debit side because it was an asset, and the closing balance is on the debit side because it is the carrying balance of a liability. That means the current tax payable being a liability by the end of the year 2010. So now both balances are on the debit side. Take note of that. This is the current tax, not normal tax, current tax. So now that means the balances are both on the debit side. Opening balance 3,220, it was an asset, and closing or balance carried down is on the debit side, which is the closing balance of a liability because the current tax by the end of the year was a liability. Take note of that, please. Don't be confused. If you still need more clarity, contact me. Therefore, now we have to record our tax expense for the current year. Our tax expense for the current year is what we were liable to pay to SARS by the end of the current year. And the tax for the current year will be in the income statement. And in the income statement, there was income tax expense, which is 88,944. In the income statement, income tax was 88,944. The income tax will be recorded on the credit side of the ledger account. It will be taxation expense. This will be taxation expense of 88,000. Confirm 944. 88,944. This was our tax expense for the current year. Obviously, this would have been after maybe the assessment was taken into account or before. So now we have to take the total of the bigger side. We calculate which side is bigger. Obviously, credit side will be bigger because on the debit side we have few thousands. So now credit side will be the bigger one, 88,944. Write it at the bottom, 88,944. Then after we say 88,944 minus 3,220 on the debit side, minus 6,444 on the debit side, and this will give us the tax that would have been paid to SARS by the end of the current year. And that tax will be bank on the debit side, meaning on the debit side we say bank, and that bank will be the difference of 79,000, how much? 280. 79,280 on the debit side as bank. That means this is the amount of tax that the business would have paid to SARS by the end of the current year. Therefore, now normal tax paid will be recorded as 79,280 rands negative, indicating outflow of cash or money going out of the business. That will be 79,280 as taxation paid. Make sure that, guys, you master all these calculations and you have to know all of them. Otherwise, you will get nothing in cash flow. Therefore, now let us do the total. That means the interest paid, interest received, dividends. You must put brackets on all those four amounts. The total of all these amounts, we must put the brackets there and withdraw the line total going through so that we get to see how much the total of cash that was finally cash generated from operations. So now let us calculate that and we'll circle it right now. So now we'll have to say tax was, let us start with 1,755,755 cash received from customers, and we, okay, let us first add all these. Let us just start here because we already know that this minus this will give us 343,080. So now I can just say 343,080 minus 68,134 plus 1,600 minus 112,500 minus 79,250. Then this gives us 84,007. Let me just confirm all the calculations. 343,080 minus 68,134 plus 1,600 minus 112,500. Then after minus 79,280. Then this gives us cash flow from operating activities. Our cash flow from operating activities is 84,766. So now that is our total cash flow from operating activities, 84,766. Therefore, now we are done with the first cash flow from operating activities. Then after we go to the next part of the cash flow, which is cash flow from investing activities. Another very tricky part of cash flow, and it's very exciting. Cash flow from financing activity, investing activities. Cash flows from investing activities. And this part of cash flow is focusing under the non-current assets and sometimes current assets. But most of the times this is focusing under non-current assets. Why am I saying also under current assets? Because if there is a short-term investment will be recorded under current assets. And the short-term investment is an asset. Therefore, now a short-term investment will be a current asset, but an item that affects our cash flow from investing activity. However, most of the times we take only under non-current assets. So now let us look if did we sell any asset or did we buy any asset? Did any money come into the business because of the sale of any asset, or did any money go out of the business because of any sale of an asset? So now let us take that into account, or any purchase of the asset, money going out or money coming in. Now we know that additional information number 1 was based on the financing activities. And additional information number 1. Additional information number 2 was based on the sale of some assets. So now that means under the second additional information, therefore now that is where the main focus will be. Then we see further what else will be done from there. Second adjustment said during the year, the following transactions took place with regard to non-current assets and were included in the profit before tax. And when they say were included, remember, they were referring to the profits that were made on the sale of these assets. So now, that means when we are recording, we start with the first bullet point under number 2, which says investment which cost 62,500 were sold at a profit of 6,225. So now what do we need to record with regard to this investment is the money that was received, because we are doing cash flow. We are focusing on the cash flow that came into the business. Therefore, now under cash flow, let us write proceeds from the sale of investments. Under cash flow from investing activities, we write proceeds from the sale of investment. That means money that we received from the sale of this investment. In this case, we know that the cost of the investment was 62,500, and investment does not depreciate. Investment does not depreciate. If you go now under the non-current assets, go to the balance sheet under the non-current asset. In your statement of financial position under the non-current asset, we have investment there at the bottom of that round table there. We have investment, and if you see in that investment, we don't have accumulated depreciation for investment. That means investment in this case does not depreciate like any other normal asset. However, investment can also be written down. There can be a write down of investment or impairment of investment. So now in this case, it means we have to say money that was received on the sale of this investment will be the cost of the investment, and the cost of the investment was 62,500 plus the profit of 6,225. That will be the money that was received. Why am I adding the profit? Is because if you make a profit on the sale of an asset, it means you sold the asset at the price that is higher than the cost or the value of that asset by the profit. Meaning now this asset was sold at a price higher than the cost of this investment, and the price meaning it was above the cost price by 6,225. That is why now when we calculate the money received, it will be 62,500, which is the cost of the investment, plus 6,225. That will give us a total of 68,728. Meaning, although the value of the investment or the cost of the investment was 62,500, the investment was sold at a selling price of 68,728 in order for them to get a profit of 6,225. Let me recalculate that. 62,500 plus 6,225, that will give us 68,725, not 28. 68,725 will be the proceeds on the sale of this investment. 62,500 plus 6,225, that will be 68,725. That will be the proceeds on the sale of the investment. Therefore, now this is the amount that will be recorded as the proceeds, 68,725. 68,725, that will be the proceeds from the sale of the investment. It was sold at a profit. That will be positive because the money came into the business. Then now we must look for the ledger account to check if was not there any other investment that was raised. Let us then now open a ledger account for investment. It does not end there. We have to check now if was there any other investment that was raised during the year or not. Then we open the ledger account for investment. We open the ledger account for investment. And for this, they will not require you to do. You must just know that after you have sold an asset, take into account the ledger account to determine if was not there any other one that was bought during the year. So now under the investment, we have to go to the statement of financial position. We are doing the ledger account for investment. And now under the investment, we have seen that our investment opening balance in the statement of financial position, our investment opening balance is 125,000, and the investment opening balance will be on the debit side 125,000 because an asset, and the closing balance will be 185,000, which is the balance at the end of the year 2010. On the credit side, the balance carried down 185,000. Then now on the credit side of the investment account, we know that investment that was costing how much? 62,500 was sold. We know that under bullet point number 1, that investment that costed 62,500 was sold. Therefore, now that will be recorded on the credit side as a disposal of investment. Disposal of investment, or others can say asset disposal. Disposal of investment. And that was 62,500 on the credit side. That is investment that was sold. Therefore, now there was nothing else to be recorded with regard to the investment. Therefore, now we calculate the total of the bigger side. And the total of the bigger side will determine either was there any other investment that was purchased during the year or raised or not. Therefore, now we say credit side first was 62,500 plus the closing balance of 185,000, and the total of the credit side is 247,500. That means our credit side is bigger than the debit side. So now we say 247,500 the total at the bottom of the ledger account, 247,500. Then I will say 247,500 minus the debit side. And our debit side, which was the opening balance, is 125,000. That means the difference will be on the debit side. And the difference is 122,500. What is this difference for now? That's the question. That means if the difference, after we have recorded the 62,500 that was sold, the difference now is on the debit side. That means there was another investment that was raised during the year. So now that means the contra entry here will be bank. Meaning we took money again from the business during the current year and we invested that in an investment account. Therefore now this will be acquisition of investments. In this case, acquisition of investment. We have acquired another investment during the current year that amounted to 122,500. And remember once again, if the difference had fallen on the credit side, that will mean that there was another investment that was sold during the year, which would have not been mentioned maybe in the additional information. So now the minute the balance fall on the debit side, that means there was another investment that was acquired during the year. So now let us record that as acquisition of investment. That will be acquisition of investment. And remember, if we acquire an investment, we are taking money out of the business, and that will be cash outflow. Therefore now the 122,500 will be negative because we took money out of the business and we invested in an investment account. Therefore now that will be the acquisition of investment. Then we look for another entry that affect our assets. So now with regard to investment, we are done. We have taken into account what was sold, and we have taken into account also what was acquired during the current year. Proceeds and acquisitions for investment have been taken into account already. Now, the second bullet point says that property was sold for how much? For 260,000. That is the money we received on the sale of the property. So now let us record that as the proceeds from the sale of the property. Under cash flow, we say proceeds on sale of property. Proceeds from sale of property. Proceeds from sale of property. Proceeds from sale of property. Remember, proceeds is the money that you have received on the sale of an asset. In this case, our proceeds from the sale of the property is 260,000 rands, money that we received on the sale of the property. Therefore, now 260,000 will be recorded as positive because this was cash that flew into the business. 260,000 rands was the proceeds, money received. Now let us check. When it comes to the property, 260,000 is recorded, and they are saying to us after that sentence, no further sales or purchase of property were made during the year. That means there was no sale and there was also no purchase of property during the current year, and that is very exciting. It's good news. So now it means there's nothing else that will affect our property with regard to our cash flow. So now if there's nothing that was done with regard to our cash flow, it means we don't have to do a test when it comes to the ledger account of property. But I want us to open a ledger account for property so that I show you something else. Now under property, we'll have an opening balance. The opening balance of property will be from the statement of financial position. Remember, this is not necessary because they told us that there was no further property that was sold during the year or purchased during the year. However, opening balance of property will be 1,100,000. And the closing balance will be on the credit side, balance carried down 875,000 rands. Then after now, we will have to record the value of the property that was sold at 260,000. Remember, we sold under bullet point number 2. We sold a property for how much? For 260,000 rands. This is the amount the property was sold for. But we don't know how much was the value of the property. But we know that they made a profit on the sale of the property. How do I know that? I see that in the income statement. In the income statement, the third bullet point said profit on sale of property. How much? 35,000 rands. If you still remember that. There was a profit on sale of property in the income statement. That means that profit that you see there indicate that the value of the property was less than 260,000, which is the price it was sold for. Meaning, if you say 260,000, which is the selling price, we minus 35,000, which is the profit. This will give us the value of the property on the day it was sold. That means now, if we say 260,000 minus the profit of 35,000, this will give us a value of the property 260,000 rands minus 35,000 rands. This will give us 225,000 rands. That means the value of this property when it was sold, it was 225,000 rands. But it was sold for how much? For 260,000. Therefore, a profit of 35,000 rands was made. So now that means if you are given these figures, you'll still be able to calculate the profit on the sale of the property. So now that means on the credit side of the property, we write asset disposal. And our asset disposal will be 225,000 rands. Our asset disposal will be 225,000 rands, which is the value of the property when it was sold. Then after we say 225 plus 875,000 rands, that gives us how much? 1,100,000 rands. That means our debit side equals our credit side. That means they are right when they are saying that there was no further purchase or sale of property during the current year. And this proves this to be correct. Because on the debit side, we have 1,100,000. And on the credit side, the total is 1,100,000. There's no difference. Remember, if there was a difference, the difference would have been another property acquired, which was going to contradict with what they are saying. That means what they are saying is correct. There was no further sale or purchase of property during the current year. There was no need for us to prove this. However, it's very important for your understanding of how to tackle the question of cash flow or in the topic of cash flow. The next bullet point is bullet point number 3 under additional information number 2, which says no equipment was sold during the year. And you wonder, why are they telling you this? No equipment was sold during the year. Therefore, what do we do with the equipment? We still have to go and check if was there any equipment that was acquired during the year. The fact that they say no equipment sold does not mean no equipment acquired. They just give us one dimension to say no equipment sold, but there might be equipment that was acquired during the year. So now let us check if was there any equipment that was bought during the year, because the one that was sold, they say it was not there. They did not sell, but they could have bought some equipment during the year. Now under equipment, remember we go under equipment cost price, not carrying value. Under equipment, in the year 2008, equipment was how much? 2009, 200,000 rands cost. But in the year 2010, equipment is how much? 240,000. Why will equipment increase? That means they did purchase one equipment during the year, but there was no sale of equipment. So now that means 24,000 rands, which is 200,000 rands minus 240,000, which is 24,000 rands, will be equipment acquired during the year. That will mean it's acquisitions of equipment. So now let us record that as acquisition of equipment during the year in the cash flow from investing activities. Then we say acquisition of equipment. Acquisition of equipment. And acquisition of equipment will be 24,000 rands. It must be negative because money went out of the business. We bought equipment, money went out. So now that will be an item of equipment that was bought during the year. Take note of this bullet point because they say no equipment was sold. In this case, we are recording the one that was bought, not the one that was sold, because there was no sale of equipment. So there's nothing else with regard to equipment that you must take into account because there was no equipment that was sold. The next one under investment will be vehicles. And if you see now, under additional information, the next one is number 3. Let us go to number 3 first. Number 3 says there were no components of other comprehensive. Okay, that is good. Then after they say an additional, number 4, an additional short-term loan of 50,000 was raised. So now this has to do with the financing activity. That means now we must go to our balance sheet. When you're done with the adjustment, go to balance sheet and you look for other non-current assets that were not taken into account in the adjustments or additional information. In this case, we know that motor vehicle is an investment, and we must take into account any purchase of motor vehicle if there was a purchase of motor vehicle during the year. Because property, remember, property is done, equipment is done. What is left now? And also investment is done. The only asset that is left that is an investment is a vehicle. Therefore, now if you see under vehicles, vehicle at cost, there were no vehicles in the year 2009. But in the year 2010, these vehicles amounted to how much? 180,000 rands. That means we bought a vehicle in the current year, meaning money went out of the business. Therefore, now we have to record acquisition of vehicles, 180,000. Acquisition of vehicles, or in fact of vehicle, 180,000. This will have to be negative. 180,000 rands. This is money going out of the business. This is money going out of the business. Now, let us check if is there any other thing that we are missing. Let us check if is there any other thing that we are missing. There is nothing else, but let us open a ledger account for equipment. I want to do that because we have done the opening balance and the closing balance of equipment. Okay, we have recorded the incorrect amount here. We have recorded the incorrect amount. I did not calculate this properly. Our equipment is 40,000, not 24,000. I recorded by mistake 24,000. Please adjust that. Because our equipment cost, it was 200,000 2009. And in the year 2010, it was 240,000. The difference is 40,000. Sorry for that. I wrote 24,000. So now the acquisition of equipment is 40,000, which is 200,000 minus 240,000. Therefore, now that means we just have to adjust that and we say 40,000 rands. That means acquisition of equipment is 40,000 rands. Then now we have completed that. So now we have recorded everything that has to do with a cash flow from investing activity. Let us calculate our total now so that when we're done, we just conclude everything. 68,725 plus, minus 122,500 plus 260,000 rands minus 40,000 rands minus 180,000 rands. This will give us negative 13,775. It is negative 13,775. It's negative. Take note, signs in cash flow, they count. Then now we do the last part of cash flow. The last part of cash flow. Last part of cash flow, it is cash flows from financing activities. From financing activities. Then now we are looking at the financing activities of the cash flow. Then now we Under financing activities of the cash flow, we are looking at the financing, which is normally the non-current liabilities, the current liabilities, and the equity section, which is equity and liabilities in fact. Let us start with the adjustment. Remember, there might be an adjustment that would have said something about the financing of the business. Remember, a business can be financed through shares, a business can be financed through debentures, and a business can be financed through loans. So now always look for the three. Look for the shares, look for the debentures, and look for the loan. If there are those three, therefore now they must be taken into account in the cash flow from financing activities. And additional information number 1 spoke about the shares. So now the business on the 31st of May issued 250,000 preference shares at 55 cents, and there was a share issue cost, meaning now it will be 250,000 shares times by 0.55, and this will give us a total of 137,000 rands. This was preference shares, and these preference shares were 250,000 rands times by 0.55, and that will amount to 137,500. Remember, there was a share issue cost. We cannot ignore the share issue cost. Unfortunately, we have already done shares by this point in time. So now you know that share issue cost will be reducing the proceeds from the issue of shares minus 1,150. Therefore, now proceeds from the issue of shares will be minus 1,150. It will be 136,350. That will be the proceeds from the issue of preference shares. Let us record that under financing activities. Proceeds from issue of preference shares. Proceeds from issue of preference shares. Don't forget to show brackets. Don't forget to show brackets as workings. And I will write the total amount of 136,350. But show your workings in brackets that it was 137,500 minus 1,150, and that became a total of 136,350. Please show the workings. I just have limited space. So now that will be positive because it's money that we have received. There was a loan that was raised during the year, short-term loan. That was adjustment or additional information number 4, because number 2 was regarding asset, number 3 with the income statement, which will have affected the reconciliation note. Number 4, they said an additional short-term loan of 50,000 was raised. Now, before we record that as money coming in, because if we raise a loan, that means we are borrowing money from the bank and we receive that. It's money coming to the business. Before we do that, let us go to current liabilities, because this is a short-term loan, and a short-term loan will be under current liabilities. Under current liabilities, we have a short-term loan, and the short-term loan in the year 2009 was nothing. In the year 2010 is how much? 50,000. That means even if that adjustment was not there, we're still going to be able to record using our statement of financial position that a short-term loan was raised and it was 50,000 rands. So now let us record that as short-term loan raised. We record that as short-term loan raised under financing activities. Short-term loan raised. Therefore, now the short-term loan raised was 50,000. That is money that came into the business because of the loan. Then now that will be positive 50,000 rands. The next one, there is no other adjustment now with regard to the financing activities. Then now let us go to our equity and liability section. Our equity and liability section, share capital and reserve is the combination. We don't calculate that because there's capital and there's also some reserves. So we can't say the difference will be money that was received. We go straight to our non-current liabilities. If there were debentures, please take this into account. If there were debentures, take that into account, that it will be either payment of debentures or money coming in because of issue of debentures. In this case, there were no debentures, but we only had a long-term loan. Long-term loan in the year 2009 was how much? 312,500, and it went down to how much? To 125,000. That means we paid part of the loan. Obviously, the only time a loan can decrease is because we paid it. That means the question is, how much do we pay? We paid the difference, obviously. 312,500 minus 125,000 rands. That means we paid 187,500 during the current year. 187,500 was paid to the long-term loan. Therefore, now we go and we record that as money going out because of the repayment of bond. Then the description will be repayment of mortgage bond. Repayment of mortgage bond. Mortgage bond. This was a bond and this repayment was 187,500. Let me confirm that. Yes, 187,000. It will have to be negative because we have paid it and money is going out of the business. Money is going out of the business. And there is no other component of cash flow from financing activities. There is no other element. We look, account receivables, no. We have taken into account the mortgage loan. As I said to you that if there were debentures, you'll have to take them into account. Depending to either debentures increase or they decrease. If the debentures are increasing, that will be a plus. If debentures are decreasing, that will mean that we have redeemed some debentures to our debenture holders. Therefore, it will be cash going out in the form of payment of debentures. Then now we can calculate our total. 187,500, 50,000 and 136,350. That will give us negative 1,150. 1,150 negative because it's 136,350 plus 50,000 minus 187,500. That is 136,350 plus 50,000 minus 187,500. That is 1,150 negative. So now let us calculate the net increase or decrease. Then when you calculate our net increase or decrease, we say cash flow from operating activities in the beginning. Cash flow total from operating activities, which was total 84,766. We say minus cash flow from investing activities because it was negative 13,775. Then after we have negative 1,150, and that will give us a total of 69,849. That will be, we don't know either is it net increase or decrease, but that total will be 69,841. 69,841. Let me just rephrase that. We remember there are three headings of the cash flow. The first one is cash flow from operating activity, and we calculated the total for that. The total for cash flow from operating activities, it was 84,766. It was positive, take note of that. And the total of cash flow from investing activities was negative. Cash flow from investing activities was negative 13,000. Therefore, now we have to say minus 13,775. Then another total cash flow was total cash flow from financing activities. It was negative 1,150. Therefore, say negative 1,150 because it is negative. Negative 1,150. Then this will give us positive 69,841. We don't know either is it net increase or decrease. Let me just say net in cash and cash equivalent. I will write equivalent. Then now let us go and check our bank account. Although this is not allowed, I'll have to go to the next page. In our bank account, we have cash and cash equivalent beginning of the year. That means opening balance of bank. Our opening balance of bank was a total, it was an asset, 42,150. And opening balance is lower than the closing balance. That means this is net increase in cash and cash equivalent. Bank account increase from this amount to that amount. So now we say cash and cash equivalent beginning of the year. This is continuation of the last part. Cash and cash equivalent beginning of the year. And our opening balance beginning of the year is 42,150, and it's an increase because it went up. 42,150. Then after we have cash and cash equivalent end of the year. Cash and cash equivalent end of the year. Our cash and cash equivalent end of the year is 111,991. 111,991. 111,991. So now this is surely an increase. And if you say closing balance minus opening balance, closing balance being 111,991 minus opening balance of 42,150, you see the difference is 69,841 is the same as the total that we have calculated in the bottom from beginning of cash flow until the end of the cash flow. So now that is the same thing. That means our cash flow will be net increase. This will be net increase in cash and cash equivalent. That means there was increase in our bank account from opening balance to closing balance. Therefore now that will be the end of this cash flow, and it was out of 20 marks. And I hope you have grabbed something out of this, and let me say thank you. God bless you guys.